To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Hi friends, in this chapter we'll understand accounting from incomplete records. Now as the name itself suggests, there are records which are not complete and we are expected to do the accounting. Now here accounting doesn't mean passing entries, but what we are more bothered about is how to determine the profit for a particular period and how to arrive at the financial position. These are the two aspects that we will be dealing in this chapter whenever we are faced with incomplete records. Now the logic that we are going to use in this chapter, you would have already used a part of that when you prepared cash flow statements or when you learned your insurance chapter. We'll just build on those logics and understand how do we prepare final accounts when records are not complete. Now when we're talking about incomplete records, what we are normally referring to is the single entry system of accounting. Now you all have learned the double entry system of accounting. What is a double entry system? For every transaction there are dual aspects or two aspects or two elements. One a debit element, other one is a credit element. For example, when you make sales, if you are selling on credit, you will debit the accounts receivable, you will credit the sales account. That is what is a double entry system of accounting. And under double entry system, you pass the journal entries or you prepare your subsidiary books, you post them into the ledger accounts. From that, you will prepare a trial balance. And remember that a trial balance is a complete record. It is something which balances various ledger. The total always tallies, and even if there are errors, you can figure out and correct them. So from a complete trial balance, it's very easy to prepare your trading account, your profit and loss account and the balance sheet. Now what we are referring to is a single entry system where the dual accounting aspects or the dual entry aspects are not followed. Meaning to say, in a single entry system, it is not always necessary that every transaction is split into two parts or every transaction has two elements. You are posting one debit, you are posting one credit. That rule will not be followed always. In some cases, they may be followed, but largely under a single entry system, you do not follow the rules of double entry system. Now, when you do not follow the rules, the accounting is not complete. Let me give you an example to better understand how this single entry system works. Now let me take you through a single entry system which I have personally seen. My dad had a business, a small retail business, where he used to religiously follow this single entry system. Now he used to prepare a lot of accounting records, but nowhere did he follow the double entry system of accounting except for a few ledger accounts. Now, what are the various books that he used to maintain? He used to maintain a cash book or a day book in which he used to capture what is the opening cash balance, what were the various receipts during the day, and what were the various payments during the day, and what was the closing balance. So in this cash book, religiously, whatever was the money that was coming in and whatever was the money that was going out, that used to be recorded. Then he used to maintain something like a purchase register called a purchase book, where he used to record all the credit purchases. Now this is very much like our purchases book that we maintain under the subsidiary books, but only credit purchases. Cash purchases he used to record in the cash book. Now it is looking like a double entry system, but it actually is not a double entry system. Then he used to maintain a creditors book. Now in the creditors book, he used to note down all the creditors from whom he has made purchases, what were the purchases on credit, what is the amount that has been paid, and what is the closing balance. So partly information flew from cash book to this creditors book, where he used to maintain various creditors ledger. Then he used to maintain something called a debtors book, where whenever he made sales on credit, he used to record in that book, and whenever the debtor used to give cash, he used to record in that book. So far it looks so simple, it looks like double entry system. Now here comes the catch. Whenever he made sales on credit, he never considered that as sales. He used to consider those transactions as sales only when he received cash from the customer. So in effect, whatever he was accounting for as sales were only cash sales. If a customer buys some product today and he makes the payment after 1 month, he used to record it as cash sales after 1 month. He never used to record it as sale on the day when the sale actually happened. Though he used to maintain a list, okay, I have sold to Mr. Ram, I have to receive 1000 rupees, but he will not consider it as sales. That was the heights of prudence concept. We will account for sales only when we receive cash. Whereas when it came to purchases, credit purchases, he used to record as and when he made the purchases. Then he had one more book in which he maintained various expenses ledger. Now whenever he made payments in cash, he used to record in that particular ledger. Now look at this entire system. Does it look complete in any sense? Now, if you have to figure out what is the total sales for a period, you will not be able to figure out because sales are considered only on cash basis. Though you are making credit sales, sales were considered only when money was received. So, sales information was never complete. Similarly, though he maintained a purchase book, he never used to figure out he never used to total up what are the total purchases. He used to only consider what are the total credit purchases. Whatever was going through the cash book was always being ignored. Then coming to the various ledger accounts, if at all there were expenses for this month which was paid in the next month, he used to consider it as expense for the next month. Then all the personal expenses, all the household expenses, let's say he paid my fees, even that used to be recorded as an expense in that last book that I spoke about. So there is a lack of completeness. If you look at all these ledgers, you will not be able to figure out what was the sales, what is the inventory, how much is the total purchases. Only thing that you can figure out is what is the total cash balance that he was most concerned about. What was my opening cash balance? What is my closing cash balance? Is that cash balance increasing? That is how he used to run his business. But when it came to sales, he was never bothered about what is the total sales. When it came to purchases, the total information about the purchases was not available at a single place. Various expenses were mixed. Personal expenses, family expenses, business expenses, everything was mixed. Again, that was being done on a cash basis. So, because of all this thing, when I first learned accounting and I thought I will figure out how much profit we earn every year, it was not easy for me. It was very difficult till the time I got introduced to this chapter, which was single entry system or accounting from incomplete records. Now, if you see, a lot of information is recorded, but these are not complete. Now, in this chapter, we will understand how to figure out or how to find out what are the total sales, how to find out what is the inventory, how to find out what are the various expenses on accrued basis, how to segregate personal expenses or drawings from the business related expenses, how to figure out the cash position, how to figure out various missing information. That is what we will learn from this chapter. Now, in the example that I gave you just now, my dad never used to follow the double entry concept or the double entry principles. Though the books look like double entry system of accounting, the principles were never followed. For example, if he made sale on credit, he used to post it in the debtors ledger, but the second part of it, that is the sales part, was never recorded. Now, when you do this kind of a transaction, how will you prepare a trial balance? You only have one leg. Now imagine the customer came next year and he paid that, whatever is due to him. He paid 1000 rupees what was due from him. At that point of time, he used to record it as a receipt in the cash book. He used to record it as receipt from customer in the customer account, and he used to also record it as cash sales. So there is no double entry system. Firstly, he recorded only one part. Now he recorded three parts of the single transaction. Now this makes the accounting from incomplete record slightly complex. We have to apply our knowledge, we have to analyze the information and figure out what is the profitability and what is the financial position. Now in today's scenario, there are a lot of businesses who use proper accounting. They use computers for accounting. They use the basic accounting softwares that are available. So a lot of businesses have already moved from this single entry to double entry system, but still there are a lot of businesses, small kirana shops, small retail shops, your tea wala, your chaat wala. These people, they do not maintain complete records. For them, they will simply maintain what is their cash balance, how much of cash they have received, how much of cash they have paid, how much of cash they have to pay to the suppliers. That's it. That is a single record that they maintain. Now this record is not complete. You cannot prepare financial statements from that records. Now that is where this chapter becomes important. For example, if there is a chaat wala who sells bhel puri, pani puri every day, now that person is not going to maintain what is the inventory. What is the inventory of flour? What is the inventory of potato? What is the inventory of onion? He'll just say, okay, I have 5 kgs, 10 kgs. That is what is registered in his mind. But if you go and ask him how much of profit does he make, he'll simply say, okay, I started in the morning with 1000 rupees. At the end of the day, I have 2000 rupees. The 1000 rupees is his surplus. But that is not accounting in true aspect, or that is not accounting in true sense. That is not how you derive profitability. Now for such businesses where accounting is not complete, we will use concepts from this chapter to prepare financial statements. Now those financial statements will not again be complete and reliable, but still we will be able to figure out, or we will be able to ascertain what is the profit and what is the financial position. Like I said earlier, these concepts you have partly used in your cash flow chapter and also insurance claims chapter. Similar principles, as we take up problems, we will try to understand what are the various things we need to keep in mind when we solve problems from this chapter. Now that we have understood basics about this single entry system, let us quickly understand the 3 types of single entry system that exist. The first one is a pure single entry system. Now what does this pure single entry system mean? In this single entry system, you only maintain personal accounts. How much money you have to receive from your debtors, how much money you have to pay to your creditors. Other than that, you do not maintain anything about cash balance, you don't maintain your purchase ledgers, you don't have your purchases book, you do not have any other information. That is the only information which is available regarding amount receivable and payable. Only personal accounts are maintained. Now with this, it's very difficult to prepare the final accounts, or it's very difficult to figure out the profits and the financial position. The next category is a simple single entry system. Now in this simple single entry system, you not only maintain the personal accounts, that is your debtors ledger and your creditors ledger, you also maintain your cash book. Now what does this cash book capture? All the cash related transactions. Now even here, you do not maintain any further details regarding your expenses and all those items. Then the third one is quasi single entry system. This is like a bridge between a single entry system and a double entry system. So you maintain your personal accounts, that is your debtors account and your creditors account. You also maintain your cash book, you maintain your purchases book, you maintain your sales book, and maybe some other information regarding expenses, right? So that is a quasi single entry system. Now this third category fits into my dad's example, where he was maintaining something like a double entry system, but again it was not a complete double entry system, it was still a single entry system, right? These are the 3 broad categories, mostly for academic reference. Now what we will do is, we will take some small examples and figure out how do we calculate profits when accounting records are not complete. Now to figure out how do we compute profits in case of accounting from incomplete records, let us go back to the double entry system. Now under a double entry system, we know we used to have a trial balance. On the basis of that trial balance, we used to prepare trading and profit and loss account, and we used to get a profit number, or it could also be a loss number, but let's assume we have a net profit. Now what would you do with this net profit? You would take this net profit to the balance sheet. Now in the balance sheet, we used to have opening capital. Now to that opening capital, we used to add profits to arrive at the closing capital. Assuming there were no further investments, there were no further drawings in the period. So we have this profit number. That profit number, if you add to the opening capital, you will get the closing capital, which is shown in the balance sheet. In other words, if I have to write it as an equation where there is no fresh capital introduction and there are no drawings, opening capital plus profit is equal to the closing capital. Correct? Now, if opening capital plus profit is equal to closing capital, can I say profit is equal to closing capital minus opening capital? Yes, I can absolutely say that. So, I can arrive at the profit by comparing the closing capital and the opening capital. The difference between these two will give me the profit. But here is a catch. If at all there are further investments or if at all there are drawings, this equation will also change. So, come back to the balance sheet. You have opening capital and let us say the proprietor introduced some more capital into the business. What would you do? You would say add fresh capital introduced. So, you have opening capital plus fresh capital minus any drawings. If the proprietor or if the partners have drawn money from the business, you will reduce that drawing and then you will add the profit for the period to arrive at the closing capital. In other words, opening capital plus any new investments minus drawings plus profits. Now, when I say plus profits, if it is a loss, it will be a negative number. So, if you add the profits, you will arrive at the closing capital, right? Now, if I have to translate this into an equation, I'll say opening capital plus new capital or fresh capital introduced minus drawings plus profits is equal to closing capital. Now, if I have to arrive at the profit, what will the equation look like? Profit is equal to closing capital minus opening capital minus fresh capital introduced plus the drawings. Now, this equation is only for our understanding purpose. We will figure out a logical way, maybe by preparing a capital account or by preparing a statement, how to arrive at the profit. This is broadly for our understanding only. So, by comparing capital, you can find out what is the profit that the business has earned. Now, a problem with this approach is it will not give you a detailed breakup of what were the sales, what were the purchases, what is the gross profit ratio, what are the various other expenses. You only get to know what is the net profit. So, this is our first understanding or first learning in this chapter. By comparing two capitals, that is your closing capital and opening capital, and adjusting them with the new capital introduced and drawings, you can arrive at the net profit for the period. Now, this logic holds good even in the double entry system. Now, since we do not have complete accounting records, how do we arrive at this closing capital and opening capital? Because we are not maintaining proper books of accounts, we are not maintaining complete set of books of accounts. How do we arrive at this capital? How do we arrive at this closing and opening capital? For this, we prepare something called a statement of affairs. What do we prepare? Statement of affairs, which is nothing but like your balance sheet. It's not a balance sheet because it is not coming from a trial balance. We will not call it a balance sheet. It is called a statement of affairs. And what does this statement of affairs have? It will list down all your assets, all your liabilities. So, in a statement of affairs, as you can see on the screen, you have assets on one side, you have liabilities on the other side. Say for example, some fixed assets, some debtors, some cash in hand, some inventory, and on the liability side, maybe you have some creditors, right? Now, total assets minus this liability, we know equals to your capital. So, by preparing this statement, we can figure out what is the closing capital, what is the opening capital. What we will do is, we will take a small illustration and see how do we get these capital numbers, and with these capital numbers, how do we arrive at the profit. Now, when it comes to preparation of statement of affairs, we said we will need the numbers of assets and liabilities. Now, you may have a question, sir, since it is an incomplete record, how do we get to know the information of the various assets? Let's say for example, there is a building. How do we get to know what is the value of the building? For example, debtors, how do we get to know the valuation of debtors, the cash, all of these things, how do we get to know? Now, for this, we need to compile the information. It will not be directly available, we will need to compile. Say for example, there is a building. You go and ask the owner, when was the building purchased? Okay, he will say, we purchased this in this particular year. What was the cost at which you had purchased? So, you can ask that question. He will say, I purchased this building at, let's say, 10 lakhs. and you know what is the normal rate of depreciation. You can compute the depreciation and arrive at the closing balance. Similarly, for debtors, you can go to the debtors ledger or debtors book, total up all the outstanding balances, figure out what are the total debtors. When it comes to cash, go and count the physical cash as at the year end. When it comes to the bank balance, go and ask the bank what is the balance as on 31st of March, because banks will be following a double entry and they will give you a clear picture, right? Similarly, if there are any other expenses, let's say outstanding liabilities, some rent payable, telephone bills payable, go and ask the owner what is the rent for the month. He will say 10,000. Did you pay rent for the month of March? He will say no, I have not paid. So okay, that is an outstanding liability. For creditors, go to the creditors ledger. So in this way, you can actually compile the information and prepare a statement of affairs. Now for examination point of view, most of the times you will be given with the information which is required to prepare statement of affairs. Let's look at one illustration. The assets and liabilities of Mr. X as on 31st of December of year 1 and 31st of December of year 2 are as follows. So you have details of assets and liabilities. Under assets you have building. For year 1 it is 1 lakh. For year 2 there is a question mark, which means we have to find out. That is what is incomplete, that is what is missing. Then you have furniture 50,000, inventory 1,20,000 and 2,70,000. How do we get this inventory number? Go and do a physical stock check, right? If records are not available, go and do a physical stock check. You will be able to figure out what is the inventory value. Then you have sundry debtors 40,000 and 90,000, cash at bank 70,000 and 85,000, cash in hand 1,200 and 3,200, loans 1 lakh and 80,000, sundry creditors 40,000 and 70,000. So this is the information that is available. If you read further, it says depreciate the building by 2.5% and furniture by 10%. Now what does this mean? We have building balance of 1 lakh, depreciate it by 2.5% to arrive at the closing balance. Okay. Then furniture by 10%, 50,000 minus 10%, you can arrive at the closing balance. Then it says policy of the proprietor was matured during the period and the amount of rupees 40,000 is retained in the business. Now what does this mean? The proprietor had a personal insurance policy which got matured, and that maturity proceeds were 40,000. It was received in the business account or maybe the bank account of the business, and it was kept in the business. So this is as good as a fresh capital introduction. Then the proprietor took 2,000 per month for meeting family expenses. This is nothing but the drawings, right? And the question says prepare statement of affairs, and after we prepare the statement of affairs, we will also figure out what is the profit. Now let's first prepare the statement of affairs as has been asked in the question. So it looks like a balance sheet. You have liabilities on one side, assets on the other side. We call it statement of affairs. Now what does this give us? This gives us the financial position. It looks like a balance sheet, or you can, it is actually a replica of balance sheet. You list down all the assets, you list down all the liabilities, right? So you have here year 1, year 2, year 1, year 2. So under assets, what do we have? First item we have is building, and it is at 1 lakh. And what does the question ask us to do? It says depreciate building by 2.5%. So let's prepare a working note to arrive at the closing balances of building and furniture. So you have working note number 1, depreciation and closing balances. What are the two things you have? Building and furniture, right? So what is the balance as on 31st of December of year 1? 1 lakh and 50,000. 50,000. See, to save time in the examination, you can club similar workings together, right? For example, building and furniture, you know you need opening balance, depreciation and closing balance. You can club them together to save your time. Then you have depreciation, building at 2.5% and furniture at 10%. 1 lakh into 2.5% is 2,500, 50,000 into 10% is 5,000. So, balance as on 31st of December of year 2 is 1 lakh minus 2,500, you get 97,500 and here you get 45,000. Same working you can also incorporate it in the statement of affairs, it's equally valid. So 1 lakh, then after depreciation it became 97,500. Come to furniture. Furniture was 50,000 and now it is 45,000 after depreciation. Then you have inventory. Inventory of 1,20,000 and 2,70,000. Then you have sundry debtors 40,000 and 90,000. Then you have cash at hand 1,200 and 3,200. Then you have cash at bank 70,000 and 85,000. Right? This is the asset side. Come to the liability side. You have loans 1 lakh and 80,000. You have sundry creditors 40,000 and 70,000, right? So you have listed down all the assets, you have listed down all the liabilities. Let us now quickly compute what are the total assets and what is the capital portion. Remember, whatever capital you have is your balancing figure, because we know total of assets minus outside liability is the capital. Now let's do that for the year 1. So you have 1 lakh plus 50, 1 lakh 50 plus 120, 2 lakh 70 plus 40, 3 lakh 10, 3 lakh 10 plus 1200 plus 70,000. You have 3 lakhs 81,200, that is your total assets, right? Minus, if you look at the liability side, you have 1 lakh 40, so 140 if you subtract, you get 241,200, 2 lakhs 41,200. That is the opening capital. Now look at the closing capital, 97,500 plus 45,000 plus 270 plus 90,000 plus 3,200 plus 85,000 minus 1,50,000. It is 4,40,700. 440,700, right? So opening capital 241,200, closing capital 440,700. Can we simply say closing capital minus opening capital is the net profit? We cannot say that. We have to compute adjusting the drawings and the new investment. So this was 590,700. 590,700. Now what we'll do is, using this capital numbers, we'll figure out how do we compute or how do we arrive at the net profit. Now that we have ascertained what is the closing capital and what is the opening capital, let us figure out how do we arrive at the profit. Now again, I would like to recap what we learned under the double entry system. What do we normally do? We have opening capital. To this you will add new capital introduced, right? Then you will deduct any drawings, and you will add profit. If there is loss, you will deduct the loss. Once you do all this, you will arrive at the closing capital. So, if you have the opening capital numbers, if you have the profit numbers, investment numbers, the drawing numbers, you can arrive at the closing capital. Now, in this case, what do we have? We have the opening capital, which is 2,41,200. This is given to us. This is the opening capital. Then we know there was a fresh capital introduced when the policy had matured. When the policy was matured, you got 40,000, which was retained in the business. So, you will add 40,000 here. Okay. Then drawings, the question said 2,000 per month. So, 2,000 into 12 months, you have 24,000. Okay. So, 241,200 plus whatever capital you had introduced, 40,000 minus 24,000. Now, this is something which is comparable or which can be compared with the opening capital to arrive at the profit. Now, how much is this number? 241,200 plus 40,000. 241 plus 40,000 minus 24,000 is 257,200. This number is 257,200. Now, what does this mean? If there were no profits or no loss, the closing capital would have been 257,200. Now, what is the closing capital actually given? As we had computed, the closing capital was 4,40,700. Now, this 440,700, if you can compare with this, the difference is nothing but your profit. Or you can also see here this profit, this becomes your balancing figure. So, 4,40,700 minus 257,200, 1,83,500, that becomes your profit, 183,500, because these three numbers total up to 257,200 plus 1,83,500 gives you 4,40,700. By preparing this statement also, you can figure out what is the profit, where your profit is your balancing figure. Now, the same thing can be also arrived at by preparing a ledger account. Which ledger account? Capital account. So, if you draw up a capital account, you have opening balance. What's the opening balance that you have computed? By balance brought down 241,200, right? Then, when you introduce new capital, you will say by bank, because you have got proceeds from LIC, which was 40,000. Then, when you make drawings, you will say to bank, in brackets you can write drawings, or if you have prepared a separate drawings account, you can say to drawings, amount is 24,000. We know the closing balance to balance carried down is 4,40,700. Then, what is the difference if you see? 440,700 plus 24,000 is 464,700 on one side. On this side you have only 281,200. So, 464,700, which is on the debit side, minus 281,200, you get 1,83,500, which is again your balancing figure to profit for the year. So, this is another way in which you can arrive at the profit numbers. One was preparing a statement, second one was preparing a ledger account. The third way is you can rearrange this statement whatever we have. You can start with the closing capital, do all the reverse adjustments and arrive at the profit. So, you can start with your closing capital. Closing capital is 4,40,700. This is after giving effect of drawings and new capital. So, you will remove that effect because that is not a part of profit earned. So, what you will do? You will remove new capital, which is 40,000, because that is not a part of profit, it is a fresh addition. So, you will remove that effect. When you are arriving the closing capital, you will add that. When you are doing the reverse working, you will reduce it, because this 40,000 does not represent profits earned. Then you will add drawings. Why will you add drawings? This closing capital is arrived at after deducting the drawings. That means your capital has come down because of drawings, not because of loss, because of drawings. So you will add back the drawings so that this number becomes comparable with your opening capital. So the drawings amount is 24,000. You will add back. So 4,47,000 minus 40,000 is 4,07,000 plus 24,000, you get 4,24,700. This you can compare with your opening capital. So less opening capital 241,200. This difference will give you the profit of 1,83,500. So either ways you can prepare. You can prepare in the first statement that we said. You can prepare by preparing a ledger statement, or you can use this third method. The formula remains the same. We had our formula opening capital plus profit minus drawings plus new capital is equal to your closing capital, right? Now this formula can be rearranged in different ways to arrive at your profit, and the logic being simple, you will compare the closing capital and the opening capital. You will remove or you will adjust the impact of any new capital or any drawings that has come into the business. Let us now have a look at an illustration where we will see a practical application of this accounting from incomplete records. The income tax officer, on assessing the income of Shri Moti for financial years 1 and 2, feels that Shri Moti has not disclosed the full income. Now regarding this assessing income and all, you'll understand in income tax, but to give you a brief idea, every year a taxpayer has to ascertain what is his income. Every business has to ascertain what is the income of the business, and they have to pay tax accordingly. Now what is the income tax officer feeling here? That for year 1 and year 2, Mr. Moti has not disclosed the full income, and he would have not disclosed full income obviously to save some tax. He gives you the following particulars of assets and liabilities of Shri Moti as on 1st of January of year 1 and 1st of January of year 3. So what do you have? The income is for the period year 1 and year 2. You have been given the details of assets as on 1st of January of year 1 and 1st of January of year 3. So the balances as on 1st of January of year 3, you can consider it to be the closing balances on 31st of December of year 2. So we are talking about 2 years, year 1 and year 2, and we have the calendar year as the financial year. So the details as on 1st of January of year 1, assets you have cash, inventory, debtors, land and building, wife's jewelry, and liabilities you have owing to brother 40,000 and sundry creditors. Then on 1st of January of year 3, you have cash, inventory, sundry debtors, land and building, a motor car got added, okay, and there is wife's jewelry, and the loan which he had taken from his brother, now he has given a loan to his brother of worth 20,000 and sundry creditors is 55,000. Now if you look at these statements of assets and liabilities, you see the proprietor or the person has purchased a car. Now if you purchase a car, obviously you would have made some profit. With that profit you have purchased this particular car, or with the income you would have purchased the particular car. Now with these information, we will try to figure out what was his capital balance as on 1st of January of year 1, what was his capital balance as on 1st of January of year 3, compare them and figure out what was the profit. Reading on, during the 2 years, the domestic expenditure was 4,000 per month. So this is as good as drawings. Then the declared income for the financial years were 1,05,000 for year 1 and 1,23,000 for year 2. So this is what he has declared to the income tax authorities, 1,05,000 and 1,23,000. State whether the income tax officer's contention is correct. Explain by giving your workings. So what is the question all about? You have the positions as on 1st of January of year 1 and 1st of January of year 3. You have to compare these two positions and figure out what could have been the total income of this person and compare that with what he has given to the income tax authorities and conclude whether he had shown actual income or he had underreported his income. Now, the way to solve this problem is prepare statement of affairs as on 1st of January of year 1 and 1st of January of year 3 and compare the capital balances which you get, right? So, statement of affairs, right, as on 1st of January of year 1, 1st of January of year 3, 1st of January of year 1, 1st of January of year 3. You have your liabilities and you have your assets here, right. So, beginning with assets, you have cash 25,500 and next year it became 16,000. Okay. So, you can prepare a combined table so that you will save time. Then you have inventory, which is 56,000 and 91,500. Then you have sundry debtors, sundry debtors is 41,500 and you have 52,500. Then you have land and building, land and building 1,90,000 and as on 1st of January of year 3 also it is 1,90,000. Now, the building has not changed, we have not considered depreciation on this land and building. Then you have wife's jewelry. Now, there can be two ways to deal with this jewelry. One, you may say, sir, it is wife's jewelry, it is personal asset, so why should we consider it as a part of the business? But please remember, whenever you have to pay income tax, you are not only paying income tax from your income on business, for any other source also, if you have created something or if you have earned something, on that also you have to pay. Now, possible that to buy this wife's jewelry, he would have drawn money from the business and then he would have bought wife's jewelries. That is very much possible, right? Or he has some other source of income from which he would have purchased the wife's jewelry. So, we will consider it as a part of the statement of affairs for the simple reason being, the jewelry was 75,000 as on 1st of January of year 1. It went up to 1,25,000. Now, this increase would it have been possible without earning any income? That is not possible, right? So, he would have earned some income either from business or from other sources. So, we will consider that to be a part of the asset, and once you consider it to be a part of your asset, it automatically gets factored into the computation of income. See, on its own, the jewelry will not go up from 75,000 to 1,25,000, right? There has to be some source of income. So, the moment you add it to the assets, it automatically is taken care. The other way to deal with this is, don't consider wife jewelries in this particular statement of affairs and just consider the increase in jewelry value to be some income from some other sources. That is also valid, but since we are not only computing the income from business, we are computing total income of this person, so we can very well consider it to be part of our assets, right? Then next year, if you see, there was a motor car purchased, so you have a motor car. First year there was no motor car, second year the motor car was worth 1,25,000. Then second year there was also a loan to brother, which is given to be at 20,000. So, these are all the assets of Mr. Moti, business as well as personal total assets. Come to the liabilities side, loan from brother, it is given as 40,000, and sundry creditors, you have 35,000 and next year you have 55,000. So, this is the position of total assets and liabilities. With this, you can arrive at what is the capital balance, and you can compare two capital balances, adjust it obviously for the drawings and arrive at the profit. Okay. So, let us figure out what is the capital balance. So, you have 16,000 plus 91,500 plus 52,500 plus 1,90,000 plus 125,000 plus 125,000 plus 20,000. So you have 6,20,000 total of asset of year 3 minus 55,000. You get 5,65,000. So you have capital, which is your balancing figure, 5,65,000. Okay. Now come to year 1, 25,500 plus 56,000 plus 41,500 plus 1,90,000 plus 75,000. So you have 3,88,000 as your asset total, 3,88,000 minus 40,000 minus 35,000, you get 3,13,000, right. So this is the capital balance as at the beginning of year 1. Okay. Again, once again I want to re-emphasize on the concept of this wife's jewelry. As I said, you can exclude it from the business assets and consider the increase in jewelry separately as an increase in income. Again, there you may have an argument that, okay sir, he is drawing 4,000, from that he would have bought the jewelry, but please note that 4,000 is for expenses. So let us not get into that depth of assumptions. So a simple assumption could be, yes, this jewelry has been purchased, maybe there is some other source of income from which you would have purchased this jewelry, or it could be the business income from which you would have drawn extra amount and purchased this jewelry. So once you include it as a part of your assets, then it automatically gets into the computation of the total income, right. Now the other way that I was telling is not consider this here, okay, and add that 50,000 simply. Another way to handle that is from the 75,000 to 125, whatever is the increase, for that you would have needed some money. That money would have come either from business or from some other sources. If it has come from business, maybe that is a part of your additional drawings, and when you adjust that drawings, again it gets automatically adjusted. So keeping it very simple, for this chapter you can consider the total assets, total liabilities, compute the capital and proceed with the workings. Okay. Now you have capital balances of 3,13,000 and 5,65,000. Let us figure out what is the profit. Okay. Computation of net profit. So you have closing capital, which we computed as 5,65,000. Now this closing capital is arrived at after deducting the drawings, right. So you have to adjust back the drawings so that you can compare it with opening capital and arrive at the profit. This is as on 1st of January of year 3. Then add drawings. It says 4,000 per month into, don't do it 12, we have to do it 24 because we are talking about 2 years. So 4,000 into 24, it is 96,000. You will add that back, less opening capital, which we computed as 3,13,000, right. So once you do this, once you deduct this opening capital, what you will get is the profit for year 1 and 2. So 565 plus 96,000 minus 3,13,000. 3,48,000 is what is the profit. Now what was the profit that was disclosed for year 1? For year 1, he had disclosed 1,05,000. For year 2, he had disclosed 1,23,000, right. So what is the total profit disclosed? Total profit disclosed is 2,28,000. What should have been actually disclosed? 3,48,000. So income disclosed less by 1,20,000. He should have declared 3,48,000. He has actually declared only 2,28,000. So the difference, that is 1,20,000, is what has been under-reported. So what is the conclusion? Don't leave the answer here. Read the question. The question says, state whether the income tax officer's contention is correct. So hence the contention of income tax officer is correct. For this you will get 1 mark. If you don't write this conclusion at the end, you will lose 1 mark. Though your competition would have been correct, you have to answer the requirement of the question. Okay. Though your answer might be correct, if you don't give the conclusion, you will not score full mark. You will lose mark if you don't give this conclusion. So this is how sometimes it can have a practical application. See, whenever there are income tax raids, searches and all, you may not get complete records. You as an income tax officer will not be able to get all the accounting records. So simply you can say, okay, this is your total asset position, this is your total liability position, this is your capital as on date. 2 years back you have declared a capital of so much. So estimated basis, this should be your profit. So this is a tool which can be used to estimate the income of the SSC.